you for joining One Investment today on our webinar, introducing the community to PPNs and giving you some more information. I'm Eleanor Schneider from One Investment, and I have a few people in the room with me that will be going through the presentation. We have our partner and our portfolio managers from Guardian Capital. We have Brian Holland, who is in the room as well as Dino Bourdos, who will be walking you through the presentation today. I just want to give you some background in terms of, and we have Janet Wong, who is moderating the presentation for us. So any questions, what we do is we're going to ask you to hold them off till the end of the presentation, and then we can take them at that point. So you can enter any of your questions that you have through the Q&A section within the webinar. So I'd like to introduce Dino and give you a bit of background in terms of his expertise and what he brings to the table today, and then I'll hand it over to Dino and he'll walk you through the presentation. So Dino joined Guardian earlier this year as a solutions architect with a mission of creating new and innovative investment solutions for clients that target a specific risk and return profiles. Dino's career in the financial services industry began in 1995 with Canada Trust TD Bank, where he grew his career originally through successive promotions in the institutional investment management business. During his tenure, Dino oversaw significant growth in assets under management with a specific focus on derivative overlay, equity index, and structured solutions. Prior to joining Guardian, Dino held the position of Managing Director, Portfolio Management, and was the leader of Derivatives and Equity Index Strategy team. Dino graduated with a BA Economics from the University of Toronto. He is qualified as a CMT through the Market Technician Association. Dino also holds the CIM designation and is a CFA charter holder. And he knows a great deal about principal protected notes. So I will hand it over to Dino, and like I said, any questions, we'll take them at the end.
Thanks, Eleanor, and welcome everybody. I appreciate you taking the time to call in for the webinar today. As the title signifies, we will be talking about principal protected notes, and specifically what I want to get into is demystifying some of the inner workings of principal protected notes and help determine whether they are necessarily the right investment strategy for your particular municipality. Now, principal protected notes are, at their core, very similar to a fixed income instrument. They're issued by banks. They trade very similar to bonds in that they're sensitive to interest rates. But the key, as with bonds, is that your principal at the end is guaranteed as a result of the principal protected note. And the difference, I'd say, of a principal protected note versus a bond is that largely you're going to forfeit earning coupons for the opportunity to potentially participate in the equity market. And that will be determined by what happens over the foregoing period in the equity market and the way they structure the PPNs. And I'm going to get into a lot of detail on that through the presentation. And so what I'd like to start with is at the high level, what is the agenda? We're going to look at what PPNs are and how they work. I'll illustrate a few examples of hypothetically, how might your experience have been in a PPN in two various different periods, one where the market was down and one where the market was up? And then I'm going to wrap it up and try to address that question, are they right for you, by summarizing the presentation and giving you some perspective. And so at the core, what we want to understand is how PPNs ensure the guarantee. And for the purposes of this webinar, we're going to talk about one of the structures called the zero coupon structure. And this largely is the most common structure that is used for fully guaranteed PPNs in the marketplace. There is other structures in the market. One is known as the CPPI structure. This is a constant proportion portfolio insurance structure. It had been probably more common historically. However, there's a number of drawbacks with this structure. And one in particular is that if there's an adverse market move early on in the life of the PPN, then it would knock you out of the equity market and you would never be able to participate on any equity participation. So that's why I think to a large extent after the financial crisis 2008 and the tech burst in 2000, 2002, that many of the dealers and the banks have moved to a structure much more common to the zero coupon bond structure. And so within the zero coupon bond structure, there are two key components that make up the investments that are within the principal protected note. The first is a purchase of a zero coupon bond And the reason why the purchase of the zero coupon bond happens is to guarantee the principal at maturity. And the way these PPNs work is that if based on the principal that you invest into the PPN is what the banks are guaranteeing you that you will receive at the maturity of the PPN. And so by buying a zero coupon bond, they buy that at a discount today with a face value that is equivalent to the principal that's invested into these principal protected notes. And so by their very design, the principal is guaranteed as a function of owning this zero coupon bond. And so, there really isn't any magic as to how the principal is guaranteed. It's all in the math. And the math is that you buy the zero coupon bond at a discount today with a face value that equates to your principal value, which is what you're going to get at the maturity. Now, by buying the zero coupon bond at a discount, it leaves some residual cash. And that residual cash is what's used to do a few things. One is to pay the fees and expenses for these instruments, but any residual after that is used to buy a call option, which is a derivative, and this derivative gives you exposure to the underlying market or a basket of securities so that you can participate in the underlying market. I'm going to get into more detail on this as we go through the presentation, but just to delve a little bit deeper into each one of these two components, on the next slide, I just want to talk a little bit more about zero coupon bonds and call options, but at a very high level. And if you'd like to drill down even deeper, we'll do that during the Q&A later on. But at the core, a zero coupon bond is a fixed income instrument. It's very commonly traded. At Guardian Capital, we trade these from time to time in our investment portfolios. I can tell you that large pension plans use these, insurance companies use these. They're very commonly used financial vehicles. And similar to, as I said earlier, because these particular bonds don't pay any coupons through the life of their existence until maturity, they trade at a discount to the face value. And so by having that discount to the face value, that is what frees up capital to do other things with, i.e. get the equity market exposure. And the way you get that equity market exposure is through something called a call option. So this is a derivative. It basically it derives its value from the underlying instrument that we're doing these options on. So it would be whatever equity market or basket of securities you're looking to get exposure to. The proceeds that are available to purchase this, as I mentioned, are limited to whatever the residual is between what you've invested into the principal protected note minus the upfront cost for that zero coupon bond. And again, the assumption is that you are going to also pay some fees here that need to be netted out. And based on my industry knowledge, and this does vary from circumstance to circumstance, my sense is that it's between 50 to 60 basis points, so 0.5 to 0.6% a year in fees. So if you have a 5-year principal protected note, it could be between 3 and 3.5% in fees. So again, that has to be taken off as well as the cost of the zero coupon bond, and only that residual amount is what's used to buy those options. The exposure that you get to the underlying market is going to be a function of how much money you have available and what the cost is for those option contracts, because this is a market just like any other security, and there's a price in order to obtain that exposure. And as you'll see in some of the examples, the amount of capital that's available doesn't necessarily equate to the cost to get 100% exposure to the market. So we're going to talk a little bit more about that in a moment. The next point I think is also very important to consider as you embark on PPNs. The call options, the performance that you're going to get of the underlying market return is limited to the price return as opposed to the total return of the underlying market. And as you know, the total return is a function of both the price changes as well as the dividends that are paid in the underlying stocks that you own. With call options, you only get the price return. You do not get the dividends. So I just say that because it's important as a setup to some of the examples that I'll show later in the presentation. All right, let's move forward again, just thinking about the structure of the PPN. I already highlighted that the core is you put a dollar investment into this PPN, the dollars used to buy the zero coupon bond, the residual that's left from the purchase of that zero coupon bond, that proceeds is used to buy some exposure to the equity market through a call option. And for this example, the call options we're going to consider are call options on the XIU ETF which is the ETF that approximates the return of the S&P TSX 60. So it's the largest stocks within the composite TSX composite index. And so when you think about what happens during the life of a PPN, when you initiate it on day one to when it matures, and we've assumed a 5-year principal protected note here, is the zero coupon bond will amortize to its face value. And again, this is the math that I was referring to earlier. There's no magic in how you get your principal back. It is a function of buying that zero coupon bond at a discount and having it mature at its face value. Now, I have made a simplification here because it doesn't actually trade in a very straight line as this diagram shows. It is going to be impacted by interest rates in the marketplace, and that too can fluctuate up and down during the life of the PPN. But at maturity, it will mature at its face value. The second part, again, is going to be a function of what's going on in the market. So the first scenario that I show is an equity experience between June 2000 and 2005. In this particular circumstance, the equity market was down. So the investor actually achieved the objective they had. They wanted to be in a PPN to get exposure to the equity market, or potential to get some excess return from the equity market, but at the very least to get their principal back. And so after this 5-year horizon, you did get your principal back because the equity markets were down over this period, so the call option expires worthless. The next scenario we look at is March 2009 to March 2014. In this case, coming out of the financial crisis, as you recall, markets were very strong. So there was a positive experience coming out of the options, and you did get some excess return from being in the PPN over this 5-year period. But let's delve into these two periods more closely to see how all the mechanics work with regards to where all the money goes. Where does the dollar get allocated? And then what's the experience for you as the investor in these PPNs? We'll start with this hypothetical example from June 2000 to June 2005. Again, $1 comes into the PPN. At that point in time, the yield on a 5-year zero coupon bond was about 6.5%. So the upfront cost in order to buy that option was about 73 cents, we'll call it. You see that in the cylinder at the bottom, the price is 0.7277. So the residual, $1 minus 72.77, is about 27 or so cents. And out of that 27 or so cents, as I said earlier, a lot of things have to be covered. First of all, any fees and expenses embedded in the PPN, which I've assumed are zero for this illustration. And only the residual after that is available now to buy options on the underlying Canadian equity market. And I'll tell you, at that point in time, in order to get $1 worth of exposure through a call option, it would have cost about 32 cents or so. But we only have 27 cents. And so if you look at the top, the blue area, you can see that it says 82% market coverage. And the reason why it says 82% market coverage is because we only had 27 cents to spend, and it cost 32 cents to buy that 5-year call option. Now, in reality, you didn't even get 82% because you didn't actually have 27 cents to spend. You had probably 24 or 23.5 cents once you take out that cost and the fee that we were talking about. So that's the initiation. So understanding where your dollar is going is important, and hopefully this helps bring that to light, and we demystified that element of it. And so when you think about this 5-year period now, at June 30th, 2005, this zero coupon bond that we entered into in June 2000 will mature. And its face value is $1. So you will get your $1 back. No magic. You're basically just getting the maturity value of that zero coupon bond, and that's how they guarantee the principal and the principal protected note. As I said earlier, during this 5-year period, the market was actually down. It was down about 5% on a cumulative basis from the beginning period, the initial period, to maturity date. And so as a result, those call options will mature worthless. So as an investor in the PPNs, again, you probably achieved your objective. You wanted to be exposed to the equity market but didn't want the downside, and you got your principal back. So it was a good experience in this particular circumstance. Now let's look at a period where we know markets were very, very strong. So coming out of the financial crisis of 2008, 2009, March was basically the low point. And so let's look at how this scenario plays out. The $1 goes into the PPN. At this point in time, the yield on a 5-year zero coupon bond is actually only 3.1%. So yields have fallen quite significantly from year 2000 to year 2009. And as you are well aware, there is an inverse relationship between the yield and the price of the bond. So the higher the yield, the lower the price of the bond. The lower the yield, the higher the price of the bond. So now you can see that the price for that 5-year zero coupon bond was about 85.5 cents, which left only about 14 cents to buy the call option, assuming no fees. But again, if you had to embed the fees, it would be even less than that. At that point in time, to buy a 5-year call option for $1 worth of exposure at the prevailing price, it would have been about 30 cents, 31 or so cents. So now you only get 47% market exposure. And this is really important to keep in mind in understanding the inner workings of ultimately what the bank is going to be doing to neutralize their risk when they're selling you these PPNs. The bank is not taking any uncompensated risk when they're selling these PPNs. They're largely hedging out all the risk at the point at which they sell you these PPNs. 5 years forward, going into March 2014, the zero coupon bond matures at its face value. There you go, you get your principal back, guaranteed. Equity market was stellar over this 5-year period. The total return of the S&P 60, S&P TSX 60 was 78%. However, the excess return on the PPN over this 5-year period was only 17%. And so if some of you on the line are scratching your head thinking, well, that doesn't really triangulate for me. Well, the market was up 78%. Why did I only get 17% excess return? I think that's a really good question. And that's what I'm going to address on this next slide. I want to give you a detailed attribution of the return of the market relative to what happened in the PPN. Because when I did this analysis, I asked myself, where did the performance go? Why didn't I get all that performance in the PPN? Well, let's start with the market. So the total return of the S&P TSX 60 XIU ETF was approximately 78% over this 5-year period. As I mentioned earlier, the options only give you price return. They don't give you total return. So you need to subtract the dividend yield. So what was the dividend over this 5-year period? It's about 12%. So you leave 12% on the table because you just don't get it from the options. That's the way they're structured. Options have a price. So that 14 cents is an upfront cost to buy that option. So you paid for that. And so that cost was 14 cents. So that goes away. You don't get to keep that cost. It's like a cost of anything. It's like insurance in some respects. You buy insurance, and after the year, it's not like the insurance company rebates you that money. It's kind of the same with these option contracts. When you buy the option to participate in the market, it's an upfront cost, and nobody rebates you on that fee. So that's a sunk cost as far as the performance is concerned. The other thing you recall I mentioned is that you only had 40% market coverage because you just didn't have enough money to spend to get the $1 worth of notional market exposure. And so of the remaining return, or of the return, you only participate on 47%, so you forfeited 53%, which is that 35, which equated to 35% over this 5-year period, which ultimately leaves you with the 17% excess return that came from that call option over this 5-year period. So again, 17 is nothing to sneeze at. It's a decent return over 5-year periods with principal guarantee, but it's not 78. And I wanted to make sure that I provided this inner perspective to help people understand all the moving parts that will impact the outcome that relates to PPNs. And again, for many of you, the PPNs were a sleep well at night factor because certainly we are all concerned about adverse market moves in the marketplace, and you don't want your principal to be deteriorating. But keep in mind that these PPNs only provide a guarantee if you hold it to maturity. If you if you exit the PPN during the life of the PPN, then you will be exposed to market fluctuations. And so as a contrast, I wanted to give you a lens into various different rolling periodic returns historically on the Canadian equity market to give you a sense of the trade-off that you're making by buying PPNs versus just being invested in the equity market over the long term. And I respect that for some of you, there are some regulatory constraints as to how you were able to get into the equity market. But I think this is information that will hopefully be useful for you. So on this next slide, what I'm going to show is a range of annualized returns varying by different rolling return periods. So as a function of what your holding horizon is on the underlying equity market. And so the biggest concern that most people have is that you have this massive negative experience in any given year. So based on 60 years of history from February 29, 1956 to March 31st, 2018, if we looked at rolling one-year returns on the S&P TSX Composite and we shifted this 1 month at a time, so it's quite robust as far as what we're measuring here. The range of outcomes that you could have experienced in this market is anywhere from minus 39% to plus 87%, which is staggering, right? And so I get it. You know, for those of you who have risk aversion, having a minus 39 in any given year, especially given the nature that these proceeds are assigned to, it could be quite challenging. But one of the things that's quite interesting is that as you lengthen that term in which you're invested, you see that those bars narrow more and more. And I've limited this only to 6 years for this point that I want to make, in that at the 6-year rolling return period is the last rolling years invested period that we had a negative annualized return. And the negative annualized return for the 6-year term was only a 0.4%, so 40 basis points annualized, which is not that material. But I think what's even more riveting is when you look at the rest of these rolling return periods from 7 years and on. There is no period that experienced any negative returns in any of these rolling periods. The width of those bars, or not the width, the length of those bars, pardon me, is also shrinking. So the predictability of the range of outcomes is also narrower. And on average, the lowest return you're going to experience is between 3 and 4% annualized by being in the equity market. And the reason why I show this is just as a contrast to maybe some of the value proposition that's portrayed in the principal protected note, as you're guaranteed your downside and you're going to participate in the equity market. As you saw earlier, there are lots of costs and fees embedded that don't necessarily give you as much of the equity market as you thought. And then when you look at this lens as far as the long-term rolling return, there are very few circumstances where you need that guarantee on the downside anyways, as you lengthen your term to maturity. And keep in mind that PPNs only offer the guarantee at the maturity. If you choose to unwind it during the life of the contract, you are going to be subject to whatever is going on in the market, whether it's as a function of what the price is of the zero coupon bond, or a function of what's going on with those call options, or whatever termination and redemption fees that the banks will apply as part of their terms and conditions. So with that, let me just wrap up, and I do want to address that question, are they right for you? But first, let's just talk high level about the key messages. First of all, the principal guarantee that's within the PPNs is entirely a function of the zero coupon bond that's embedded in it. Again, there's no magic, it's just math. You put $1 in, you buy zero coupon bond at a discount, and that zero coupon bond is going to mature at its face value, which is the principal value. Okay? The equity market participation is generally going to be obtained via the call option, and that call option can be on the market index, it could be on a basket of securities. It really is flexible based on how the dealers are structuring that. And that's going to be a function of how much proceeds are available from the zero coupon bond and the fees that are going to be deducted as well. The excess return of the PPN, because it's derived from the call option, is going to be limited to the price return and the degree of exposure that you're going to have, net of all the fees, upfront fees, transaction costs, and expenses that you're going to pay to structure this inside the PPN. So again, ask questions if you're being solicited with these PPNs, to really understand how those structures are being constructed and how much exposure you're actually getting, what the embedded fees are, and what it's going to look like for you in the end. But definitely the price return is a really important point that may or may not be something people necessarily are aware of. Now, I do respect that for many of you, there's been regulatory constraints around being invested in the equity market outside of the one portfolio or PPN. So there's obviously some trade-offs that you've had to make in order to be in the equity market. The time horizon obviously is something that's going to be very important to different investors, as well as risk aversion or sensitivity to short-term losses. And so PPNs may have had a role in the portfolio as a result of that, but I don't want you to confuse the point in time guarantee that the PPNs offer versus the fact that you need to be locked in for the full term of that in order to receive that guarantee. So there might just be a misalignment between time horizon and the actual benefit you're getting out of the PPN. So it's important to consider that. Now, as I hope you were able to take out of the presentation, there are a lot of costs and limitations on how much participation you get into the equity market. And I think that that's really critical to understand and really challenge your vendors or whoever's talking to you about PPNs around what exactly you're getting inside of these notes, so that you don't have a disappointing experience at the tail end of the maturity schedule. So where do they fit? You know, are they right for you? And I thought a lot about this, and I've talked to people at One, and I've talked to Brian, who knows your market very well. And what we concluded is that if your other alternative option was to be in GICs, as an example, and you wanted to be in something that gives you the same principal protection that a GIC gives you, but with an opportunity to get at least some excess return, not necessarily the market return, but some excess return, well, maybe PPNs are a viable alternative. But if you had been considering PPNs as an equity substitute, hopefully what you saw during this presentation is that the explicit and the opportunity costs that are associated and embedded in PPNs are not that favorable. And certainly when you think about the intermediate and longer term horizons that you're invested in the marketplace. So with that, I'd like to pause and open the floor to questions. If you have any, I'm happy to clarify anything that I've covered already in the presentation, or if you have other questions that you would like addressed, I'm happy to address that as well at this time. Thank you.
Dino, can I add just a couple of more points? In terms of if you have a low risk tolerance, would you say that this is probably the product that you'd want to go for? Like a PPN would be a good option? Well,
it depends. If you have a low risk profile, you could even consider other fixed income investments or other low risk balance funds. I think that if you had a low risk tolerance and you wanted to have equity market exposure, depending on your time horizon, if you had a shorter time horizon, it's actually, I say that and then I catch myself, because if you have a shorter time horizon, maybe PPNs are fine, but you're locked into the PPN for 6 to 10 years. So technically your time horizon isn't as short as you thought, but maybe from a reporting perspective, the reporting is going to drive some of that time horizon as well. So again, as a GIC substitute or something that gives you principal protection plus the potential to get a little bit of excess return, maybe this makes sense, PPNs. But as an equity alternative and the time horizon is longer, it tends to make less and less sense given the trade-offs and costs that are embedded.
And can I make just one further point? If there's any municipality that's considering prudent, they may want to reconsider PPNs if they want to go down the road of PPNs, because that could create some restrictions for you, when you move into prudent. So if your municipality is considering going down the prudent route and moving into the new investing powers, the PPN could lock you in, and then there would be some issues in terms of the transition and moving out of that product.
Yeah, and let me expand on that. Again, the idea there is that if you were to enter into, say, a 5 or 7 year PPN today, again, the guarantee is only at maturity. Now, you may exit out of it at any time, but there may be penalties. You will be subject to market fluctuations, and your principal may or may not be guaranteed at that point because it will be a function of whatever the market value is of the underlying instruments at that time. But an important question to ask of the provider if you're considering PPNs again.
Hello everyone, Janet here. So we've got a question for Dino. What happens if markets experience growth in the early years of the PPN? Are you able to sell and realize the gain, and what portion of the gain?
Yeah. So again, this is exactly ties into the response I just gave in relation to Eleanor's point about if you're making a shift in your portfolio and you eventually need to sell these, what are you going to be subject to, right? So understanding the terms and conditions that the banks apply to their various notes is going to be important, and they are, as for some of you who've had any experience with this, it's a very thick document of disclosures with micro print, so try to make sure that your lawyers review this and understand what the implications are. But you should have the ability to either terminate it or redeem the PPN. And if you do that, ultimately it's going to be a function of what the market prices are within different parts of the component of the PPN. So to your question, if the market is up and you want to redeem it, then presumably you should get some excess return on top of the value of what the PPN is. But do keep in mind that the proportion of how much of that equity market you participate in is going to be a function of what did the brokers use to get that equity exposure, what proportion they were able to obtain, and how that instrument has moved in relation to the market during that foregoing period, because that's not so easily to answer because it's a function of a lot of different variables. And really understanding what the dealers are doing and how they structure it is going to be important, and it can be variable. I can tell you with a pretty high degree of certainty that it will not be the full equity market return.
Another question, as a buyer of a PPN, how do I know what method is being used?
Yeah, so ultimately the risk is borne by the bank, right? Because the bank is issuing this. You are ultimately going to be exposed to the credit of the bank that issues it. And so in Canada, we have a pretty high degree of certainty that the banks are going to remain in good standing. How they choose to hedge this on their books is going to be a function of what makes sense for them and other activity that's going on. But as I said, and I've pulled various different bank dealers, sense I get is that this zero coupon bond structure is what's most commonly being used at this time. So effectively, the zero coupon bond is purchased, and then with whatever residual proceeds that are left after fees and expenses, they buy a call option to that underlying market exposure. So I'd say that's more likely than not the most common, but I do encourage you to ask that question to your providers if they're soliciting these products to you.
We've got another question. How does the potential costs fees in the equity-linked PPNs compare to the MER, that's MER, of the one fund's equity fund?
So like I said, the rule of thumb that I've heard is about 50 to 60 basis points annually for the embedded fees within the PPN, and that's partly the sales charge to the advising broker and then any other management fees inside the PPN. How that compares to one portfolio, I'll pass it over to Eleanor to speak to.
It's comparable.
It's comparable.
So it sounds like it's a comparable fee, but the exposure is very, very different again. So the exposure is ultimately from what I understand about the one portfolio equity strategy, it is high quality, high dividend paying stocks that have a lot of stability over time, and they tend to have less downside risk in market adverse scenarios and so forth. But it's a little bit like comparing apples and oranges, right? Because what you're buying ultimately in the PPN is a zero coupon bond plus a call option.
Right. So you actually have two products in one in the PPN. You have some exposure to equity, and then and then you've got the balance of the fixed income that's protecting it, that zero coupon bond. Whereas in the equity, you're in 100% equities when you're invested in that product, or whatever your investment is in that portion.
Correct.
Okay, we're good with that question. Another question is it possible to explain again the idea of higher and lower market coverage tied to the call options?
Sure. Yeah, so the assumption that I've made in the analysis that I showed in the hypothetical examples is that when you enter into the PPN, you want to effectively start your exposure to the equity market based on the prevailing price. So let's assume that the prevailing price on the market index is 200 for argument's sake in June 2009. And so you enter into the 5-year principal protected note. What you want to do is own a call option that will start participating in the equity market at $200. Okay. And just like any instrument in the market, there's a price for that option. And so when we go and solicit that price, either through our dealer network, or we can compute it on tools like Bloomberg or other financial models, there's going to be effectively a premium associated with that. And that premium, as I said, could be that 32 cents for 5 years as an example. And so that is very much a function of various factors. It's going to be a function of the prevailing price in the marketplace. It's going to be a function of the time to maturity. It's going to be a function of interest rates. And the most important factor that's going to drive the price is something called implied volatility. And so effectively, through these various components and sophisticated mathematical models that drive what the assumption is around these prices, that will be the market price in which you can buy that option. And so the assumption is that that price is for $1 worth of exposure. So if it costs 32 cents to buy $1 worth of exposure through the call option for 5 years based on a starting price of 200, whatever amount of money I have left in order to buy that call option. So in the case of scenario 2, example number 2, I only had 14 cents. So if I take 14 cents divided by 32, that equals about 47%. And that's what's going to drive the proportion of exposure I'm going to be able to get to that $1 worth of market through the options. Hopefully that helps.
Who are the normal buyers of PPNs?
Yeah, interestingly enough, I did see some statistics from a report that was published earlier this year. The PPN market is a lot larger than I thought it was. In Canada, about $10 billion a year of PPNs are sold. In the US, it's about a $60 billion a year market. So clearly there's a lot of buyers. The buyers, in my estimation, are probably mostly retail investors, because a lot of the banks promote market-linked GICs and that sort of thing, and ultimately market-linked GICs are just like PPNs. Effectively, it's the same product, same structured product from the bank's perspective. So my suspicion is that it's primarily retail investors, either through banks or potentially through advisors. Because the sales commissions can be attractive for advisors to sell these things as well. And there is this perception that, I'm going to have my principal guaranteed and I get the equity market return. And that's partly true, but hopefully you saw through the presentation today that there are a number of factors that go into how much of that equity you're going to participate in and the trade-offs you're making with regards to that. But there's no question that this is a very, very large and lucrative market, both in Canada and the United States. I can tell you that, for most of my career, I worked with large institutional investors, pension plans, insurance companies, endowment funds. I can't recall if I ever saw PPNs in any of their portfolios. So I would say that this is not a commonly used institutional product, but I think it's primarily a retail product.
I've got a question here for you. Usually within which period will there be no penalties or fees to sell a PPN?
Yeah, I don't really know the answer to that question. I think it is so product by product specific, and it's going to be a function of what's in the documents that you negotiate with your provider. So unfortunately, I don't have an answer specifically for that. I think fees generally are always there. Penalties for early redemption, I don't know.
Another question. Your data indicated that over a 10-year period, the S&P TSX Composite has never lost money if held for the full 10-year period. If most PPNs have a life of 10 years, what's the value of the guarantee?
Right, and that's, again, it's a sleep well at night factor, right? And I do think that that's, understanding how human behavior also impacts your investment behavior. So there's a terrific study by I don't know if it's a group or a person called the Delbar study. Delbar is the name. And he has shown that through history, individual investors' performance systematically lags the market return. And a big part of that is because people sell at inopportune times. So when they get the big negative drop, they get nervous and they sell. But the purpose of showing that 10-year rolling return is that, sure, you can have a 1-year drop of 39%, but you can also have any 1-year upside of 89%. So the key is stay in the market for the long term, particularly if you have a long-term horizon, because those things tend to net out over time. And markets generally go up more often than they go down. I'll translate one other. So that was the behavior. I think the answer to your question is behavioral. If you have the discipline not to let your behavior take the better of you in those adverse market moves and you sell at the inopportune time, then you're right. Then being invested in the long term helps. The other element is what we call the sequence of return risk. And so if you need to access your money sooner, then having a well-balanced portfolio and a pool of liquidity that you can draw on that has less risk is very prudent. And so, we wouldn't advise that if you had a spending plan between now and 5 years from now in an annual draw, that you put all your money in the equity market. That may not be prudent, because certainly there are risks of any 1 year having a very large adverse move, and then you would be forced to liquidate your equity portfolio because you have the spend. Whereas if you're not going to be touching the pool of money for a long, long time, then being in the equity market over the long term has historically shown to be a better alternative versus PPNs for sure, and even other investments. Equities tend to do better than bonds over the long term as well.
Are there any requirements, like credit rating requirements of the underlying assets, Canadian markets, TSX, etc.? Are there any requirements in the Municipal Act that determine what the PPN can be based off of? For example, could a municipality purchase a PPN that is based on an oil index, Euro stocks, S&P 500 index, etc.?
Yeah, my sense is that the Municipal Act is silent on that. It just says you need to be invested in fixed income instruments. And so I think part of why the PPNs have been such a popular tool at which municipalities have been targeted, whether they're by banks or retail brokers, is because it's considered a note, and a note is a permissible investment under the Municipal Act. And so the principal guarantee nature of the note is what makes it an allowable investment. What it's linked to, I think, is quite broad. It's going to be flexible, is my estimation. So I don't think it's explicit in the Municipality Act, the Municipal Act rather. The one thing I will say though is the type of PPN that the municipality can buy has to be a fully guaranteed PPN. It cannot be a non-guaranteed note. Okay, so and it's important to differentiate between those, because the market has become a lot more, there's been a lot more innovation, let's call it, in the PPN market, where there's a lot more variation of principal protected notes, many of which are non-guaranteed. But municipalities must own the fully guaranteed version, which means that inside the PPN, if the dealer doesn't want to take the risk, or the bank doesn't want to take the risk on their balance sheet, they're going to buy that zero coupon bond, because mathematically that guarantees you're going to get your principal back.
That's correct.
And they don't want to take that excess risk, right? Let's just face it. Banks are there to make money off of spreads. They're not there to make money off of speculating whether the market's going up or down.
Thank you. We'll ask one more question. Are PPNs like mutual funds where there are other investors, or do they create each PPN with every new investor?
So the way I understand PPNs get issued is almost like an origination process where if they have a version of a PPN that they want to sell, then they will go out and solicit interest into that series, we'll call it, and then they will basically pool the capital of that series, and multiple investors will own that series of the principal protected note. I think that if there was a large enough ticket, like several, I don't even know how big, let's call it 10 million or 100 million, I don't know what the threshold would be for the banks, then they would consider writing a one-off PPN. But at the end of the day, they have legal and administration costs associated with structuring these things, so I doubt that they would be issuing these for, smaller off-the-run size tickets.
Got another question. Are PPNs exempt from bank bail-in regs?
Yeah, I don't think PPNs would fall within the bail-in regs because they're not issuing these bonds to the public market. They are notes specific to investors as investment vehicles, as opposed to broad-based issuance of bonds. If you don't mind, I would like to take that away to confirm that. My estimation is that they're not subject to the bank bail-in regs, which for some of you who may or may not be aware of, effectively the risk of owning the bonds is not a guarantee from effectively the government, because the banks will be bailed out by the governments. It would basically get transferred into equity to the holders of those bonds. I don't think PPNs fall into the same category, but I do want to verify that before I confirm. So if I can get an answer back to Eleanor, and then we'll distribute that to everybody on the call.
Thank you, Dino. And that wraps up the webinar today. I'd really like to thank everyone who participated on the line today, and we hope that you were able to get the information that you wanted out of the session. I want to thank Dino and Brian for putting the presentation together for us and helping our investors understand what products are out there. Janet for helping us with the webinar and the technological side. And again, if you've got any questions, feel free to call, send me an email or Janet, and we can follow up with Dino and answer any additional questions that you may have. So, and again, we've recorded the session, just so you know, and we'll be posting it on our website. And we will also be providing the slides to the presentation as well as a follow-up. So thank you, everyone.